Well, first of all, brothers and sisters at Drainsville send their greetings. And it was funny. I thought it was being funny here when I put this up, and I realized a lot of people on Wall Street can't do this. So it's a little more serious than I thought. What we're going to do today is talk a little bit about some basic financial planning. Then we'll talk about the events of the day, what's going on now, and then do questions and answers, and we'll go from there. Anytime you have questions, threats, whatever, just raise your hand. Try not to throw dinner rolls. But anyway, so we'll start. So, the first thing you have to do when you're talking about finance is figure out how are you going to spend all this money that you're accumulating, okay? You have to set some goals, because what you're going to do with it and when you're going to do something with it really makes a huge difference as to how you plan to attack things. So here, build a laboratory, create a monster, move to a Swiss chateau with 97 rooms, and laugh and laugh and laugh. But seriously, you get a car, you get college for the kids, retirement. Any one of those are noteworthy financial goals. Now, you put a price on it, of course, which gives most people a heart attack. New car is going to set you back 20 grand. College, I think, is more like 16,000 a year these days. And retirement, well, it depends. The rule of thumb with retirement is that you can start your withdrawals at 4 to 5% of your principal if you plan to increase your withdrawals every so often for inflation, which means with $1 million you get about $50,000 for initial withdrawal, which is really depressing, but it's not quite as bad as it seems. This was something that was going on a while. This guy basically in front of every known disaster to man. It's just one of these things. And time helps. The longer you have to save, the smaller the burden of payments. If you're saving for something 5 years away, for $50,000, you need to save $833 a month. This is assuming you stuff it into a mattress and don't earn anything, which is about what you'd earn today. And so there's the $208.33 for 20 years. Okay, investing helps. Now, it is possible to get 6% these days. I would be surprised at 12, but hey, you never know what the future holds. Okay, but clearly, the more you earn, the less you have to save per month. Now, the catch to all of this is that risk and reward are joined at the hip. Okay, which is to say, the more risk you take, the more potential reward that you can get. Now, people carry this too far, okay? If you go down that slope entirely, then everyone would invest their retirement savings in lottery tickets, right? Because they're insanely risky. There's a huge potential reward, but of course there's a minute chance of success. So you have to be careful with some of these things that people say, but by and large, the more risk you take, the more potential reward you have. Now, people always downplay risk. People downplay risk because they focus on the reward. But so this is the number you have to remember. This is 1.62%. Anybody know what that number is? That's the current yield on a 10-year Treasury note. Okay, that is the amount you will earn over 10 years, every year, if you hold a U.S. Treasury note. Essentially a risk-free investment. Now, I'm saying risk-free in the sense that it is highly unlikely that it would default on you, which is the main risk with bonds. There are other risks. Inflation is running north of 2%, so you're getting a negative after inflation yield. But today, as we stand here, that is what you get if you can't take any risk whatsoever. That's your reward. Okay? Now, yeah, so that's going to become a whopping $1,174 in 10 years. That's before taxes, because it's taxable. Okay. So you can earn more by taking on more risk sometimes. And what we have in the last 15 years has been kind of an unusual situation. Normally, when you would see these charts, you'd always see, you know, stocks at about 12% and bonds at about 6% and treasury bills at about 3%. As we know, there have been two bear markets in the last 12 years, both of which were the biggest bear markets until the previous one. The only one that was larger was during the Great Depression, when the Dow Jones Industrial Average, as I'm fond of telling people, fell 89%. Okay. In 2008, the Dow fell 55%, and in 2002, it fell 45%. Those are significant losses. Long-term government bonds earned an average of 9.1%. Now, this is with increases in principal as well as reinvested interest. The reason for this is that bonds become more valuable as interest rates fall. If you have a bond that yields, way back when, in 1981, the 10-year Treasury yielded 15%. Okay? Now, supposing you had a 15% bond and rates fall to 10%. People just love you to pieces, okay? They want your bond, but in order to get it, they would have to pay up for it. They would pay extra money for it because you can't really lower the yield. The yield is the interest rate. The interest rate is set. So as interest rates fall, bond prices go up. You earn more on bonds. So since 1981, we've gone from 15.5% to 1.62%. It's the biggest bull market in the last, practically in history. And so we'll talk more about the implications of that. But bonds have earned 9.1%, Treasury bills earned 1.9%, and inflation averaged 2.4%. And here again, those who have played it fairly safe haven't really earned anything after inflation. In real terms, in real buying power, you just haven't gotten anything. Now, many ways to define risk: being eaten by a lizard, possibility of large short-term losses, down 55, down 45% in the stock market, or the possibility that you won't have enough money to meet your goals. And the ultimate risk for retirement savers is you're going to run out of money. Okay. I like lemurs. Now, so one way to look at risk is to look at, you know, what's the worst, say to yourself, what's the worst that could happen, right? And you can see here, stocks down 50% in 1932, 55% in 2008. These are single years. Long-term government bonds down 10%. Remember, when you have a bond, you have the interest payment that's going to kind of cushion your losses a little bit. Treasury bills you generally don't lose money on, but it's 0.2%. Okay? And you look at the best return. So you have to look at these things here. You know, am I willing to sacrifice a 50% gain for a potential 50% loss? And bear in mind that the two aren't equal. Okay? If you lose 50%, if you go from $1,000 to $500, you need 100% to get back to where you were. Okay? Losses have just a nasty mathematics to them. Okay? Long-term government bonds, 41%, 1982, and then Treasury bills. Now, the question then is how can you get a reasonable return while getting, you know, while reducing your risk as much as possible? Well, the first one, when we went back to talking about your goals, is that you match your goals with your investments, okay? If you're going to retire tomorrow and you put it all in the stock market, you're basically saying, okay, Mr. Market, tell me how I'm going to live for the next 30 years, okay? And you might not like that answer, okay? So what you have to do is you have to stick with a short-term safe investment. If you absolutely need that money, you can't take any risk with it, and you have to just accept the rotten returns. Top yielding CD now is 1.1%, CIT Bank, which, like many of the top yielding CD issuers, is a recipient of the bailout. Bankrate.com is a great place to look for the best, highest yielding CDs in the country. And every week they survey everyone, and they do a great job. So it's one of those things, if you are CD shopping, that's one place I would stop. Use stocks for longer term goals. basically, when you invest in a large company, stock fund, for example, the S&P 500, again, there's no guarantees that you will ever make money, but you do get a dividend yield that will somewhat cushion your losses over time. So, and you can see, you know, had you been a smart cookie and invested in 1989, you would have gotten 19% a year. 20 years from 1980 to 1999, 17%. The worst is 3.1% and 0.6%. And we did, in fact, I think that is wrong. There has been a period where you've lost money in stocks over 10 years. So it's not something you want to go into wholeheartedly. You know, it's something you want to leaven with other things that are less risky. Okay. But on the other hand, all those returns are including 25 bear markets, an average decline of 25% for the bear markets, 11 recessions, and of course Martha Stewart. The recovery doesn't usually take that long. Usually, well, the average is about 2.4 years. The longest, excluding the Great Depression, 7 years for the 1937 bear market. We are still about 10% below where we were in 2007. So that's 5 years. But the thing is, you can't control the markets. You know, we can talk about reducing risk and adding this and adding that, but you should focus on the things that you can control. Okay, you can control taxes. You can control how much to pay in taxes, and you can control expenses. So if you're in the 28% tax bracket, you need to withdraw $3,725 before taxes to get $2,500. Okay, that's a big expense. So what you need to do is, you know, get some government help, which is what everybody does, right? Start with a 401k, a Roth IRA, which are tax sheltered. You don't have to pay taxes until you make the withdrawal. And you consider other alternatives. The one thing that is nice about stocks is the maximum tax presently is 15%, and same with qualified dividends. And there's embezzlement for those who like the risky side of things. Again, it works on Wall Street. Open up a Roth IRA if you can. This is one of the things that probably the nicest thing you can do for your children who are working is to set up a Roth for them. The earnings are tax deferred and you pay nothing actually on withdrawal. And you can withdraw your principal tax-free at any time. So there's, you know, if they do need money for a house or something, they can tap that if they have to. Of course, you don't have to tell them that they can do that. It's, you know, it's up to you. Okay. And keep expenses low. It's funny, I see all these ads lately for checking accounts that are paying, you know, 1%, right? And yeah, it's a big, high-yielding checking account, except they charge you $25 a month for the account. So really, you're paying far more in fees than you're ever going to get in interest. It's just a scam. And even at mutual funds, which have to disclose their fees, nobody really pays any attention to it because they're really only looking at the returns, which are after fees. But 1.5% is what they take on average every year. Okay, so $1,500 a year. Do you pay your plumber that much? You know, it's one of these things where you start to think, once you think about it in dollar terms, it gets fairly outrageous. $72,000 over 20 years. Okay, he'd be better be a really good manager to earn that much money. And you know, that's money that you're not going to have to spend, and that's a significant amount. Now, so those are my basic. I tell people about investing. That's what I tell you. You know, look at the things you can control. You can control risk to some extent by being widely diversified. Okay? You can control your expenses by looking for low-cost funds. The Vanguard Group has some very good ones. TIAA-CREF has some good ones. DFA is another good group, where they will charge you maybe 25 basis points, which is 1/4 of a percentage point a year. Okay? And you can control your taxes as much as you can. So the question then people usually want to talk about, so what's going on in the world now? Well, how many of you are worried about inflation? Anybody? A couple. Okay. Right now, I think, Our biggest problem is really deflation, which is falling prices. Falling prices, if you look at median family income, has fallen since 2007. It means people can spend less. They're more inclined to put off purchases of things until they get cheaper. Right? Unemployment is 8.2%. The opposite is true, too. When things go up that the financial system doesn't really have any control over, gasoline gets more expensive. You don't go to your boss and say, you know, the cost of gas is killing me. Can I get a 7% raise? And they'll say, well, no, but you can look for work somewhere else, right? What you do then is that you have to cut back your expenses to pay for the necessities. Unemployment at 8.2%. That doesn't include the people who have given up looking for work, which is substantial. Home prices are at 1992 levels. Dow is still down 10% from 2007 highs. The thing about a deflationary recession, and it's generally sparked by what's called well, basically by debt defaults. Okay, if you own a company and he's borrowing from you and he defaults, you're stuck, and you either have to cut back your expenses or you have to go bankrupt, right? It becomes a thing that goes out of control. Food and gasoline, and as everyone points out, try living without food and gasoline, have been rising. But that just simply means that people cut back on other spending. You can't do without food and gasoline. High food prices are actually somewhat of a result of high gas prices because it makes makes fertilizer more expensive. And you could actually even say, and I think it would be true, is that some of the events of late, like the Arab Spring, have been triggered by that, because in many places where we've seen revolution, food is from anywhere from a third to a half of their budget. Okay, you really can't cut it. And so this is what, people who can't afford a Walkman are irate, People who can't afford breakfast for their kids are angry. So that's what we have, is a deflationary recession. Oh, the other evidence for this is that we talked about, what's the 10-year Treasury rate? 1.62, okay. Supposing you were one of these savvy Wall Street traders and you thought inflation was going to soar in the next 10 years, would you buy a 1.62% Treasury note? No. You would demand a higher yield, wouldn't you? Because you wanted to compensate for inflation. In fact, TIPS, which are Treasury inflation protected securities, and their principal rises every 6 months according to the rate of inflation, are selling at a negative yield, which means that basically if you buy it, you're guaranteed a loss. So Wall Street is saying, well, we don't see it. So that's cheerful enough. And we have Europe, okay? Europe's a mess. Spanish unemployment is 25%, it's 50% among young men. You generally don't want a bunch of young unemployed men milling around. It's one of these things that leads to bad things happening. The euro is down sharply. Spanish bonds are yielding more than 7%, which is kind of a danger sign. What's interesting to me is the Italian bonds are yielding about 6%, and they're flirting with 7%. The Italian bond market is the third largest bond market in the world. Okay, it's Italy, Japan, and us. Okay, those are the big three. When the Europeans say they're worried about the Italian bond market, they're really worried about the Italian bond market, okay? Because not only would the specter of an Italian default just be awful, but many European banks hold these bonds as capital, which is kind of a cushion against losses. So there's that problem. The other problem, and this is kind of a structural problem in Euroland, imagine if every state had its own Secretary of the Treasury. And every state could guide its fiscal policy however it wanted to. This is kind of the way Europe is, where what you have, things are humming along fine in Germany, They don't want higher taxes. They don't want higher interest rates. They're good. Their biggest fear is inflation because they're afraid the economy will warm up too much. A place like Greece, Italy, Spain, they need something to get them going. And the way the euro is set up, it really can't do that. It can't really differentiate between Spain and Germany. There's China, which has always been held up as kind of the great growth market of all times. And I always have mutual fund managers kind of walking through the office and they're saying, oh yeah, China's the next big thing. And I always say, you know these guys are still communists, right? And, but the thing about China is that their numbers that they put out are, who knows if they're, you just don't know. Is their inflation rate really 8% as they say it is? I don't know, maybe. You have to realize they view these statistics as instruments of the state. The central bank has been cutting rates recently, which is a sign of economic weakness. And they've been on this tear of building houses. And, it doesn't always work out well when you have a lot of empty houses, particularly. The Chinese, like Americans in 2007, saw home ownership as a way to prosperity and as kind of a guaranteed way to make money. And now they have a ton of houses for sale and nobody's making money. And the problem with housing bubbles is that they last a long time. And they last a long time because people just take their houses off the market when prices aren't where they want. And when prices come back, they put them back on, and that depresses it for a long period of time. But also it makes people feel poorer, keeps people from moving for a new job. If you have to write the bank a check for 20 grand to take that new job in Seattle, you're probably going to stay put, right? So China has the same problems here. So, isn't that cheerful? So, if you're interested in stocks, and this is what I've been mulling lately, is the U.S. stock market is not particularly frothy. It is enormously volatile of late, and it is something that I don't like. And volatility is a polite word for it goes up and down like crazy for no apparent reason. Okay, mostly down, and this is. Everybody loves volatility when it's going up, right? Nobody complains about a 217-point rise in the Dow. But by and large, U.S. corporate profits, for all complaining about recession, have been spectacular. And we can talk later about how they're getting these profits, which is not giving people raises and cutting prices. And people talk about American productivity, but I suspect part of that is because we work like dogs. Gannett, which is my parent company, tells the Labor Department that I work 35 hours a week, and I don't. I work 60 hours a week, and I think that's what a lot of our productivity comes from, is that we work a lot without necessarily getting paid. And all of which has redounded to corporate earnings, and that's a good thing for investors anyway. The other thing, growth stocks. Growth stocks are stocks that basically people think earnings are going to increase over time fairly sharply or more than others. Value stocks are ones that have been beaten up and smacked around and they're just dead cheap, and someday they'll come back and go back to normal. Okay, there's two camps there. Okay. And sometimes you suspect the growth guys, and the value guys just sell the same stocks back and forth to each other, and they probably do. The growth guys ride it until it collapses, and after it collapses, the value guys buy it and sell it back to the growth guys. However, at a time when growth is, earnings growth is rare, growth stocks do quite well. And in fact, growth stocks have done extremely well over the past 3 years. The other, and this is just a long, I like this for 2 reasons. Dividends, which are cash payments that companies pay to investors, are indeed swell. I've always liked dividends. They're great things. But they have two things going for them. One, again, we have enormous profits, and a lot of companies don't know what to do with these enormous profits. And I've always thought one of the greatest dangers a company has is having a ton of money. Because, like as not, they're going to do something stupid with it. Okay? They're either going to buy a company that they probably shouldn't buy, and they'll pay too much for it, or they'll go into another business that they don't know much about and lose a bunch of money in that. Or they'll buy the stock back, which really doesn't do any good for anybody except the CEO. But dividends are at least kind of a cash way of saying, okay, look, I earned this money, and not only did I earn this money, but I'm probably going to earn this much next time, because cutting a dividend is a fatal thing on Wall Street. The other thing that I like about dividends is that there are 77 million baby boomers heading for retirement. 11,000 are reaching 65 every day. And when you're retired, you really like dividends. It's nice to get cash payments on a regular basis. It's just a good thing. And these same guys who were wearing yellow power ties and bidding up tech stocks in the 80s and 90s are now talking soberly about, oh, look at the dividend on Pfizer, and wow, when will GE raise their dividend? So it's a secular trend. The people who are in the hardest place are those who are looking for income, trying to get some more cash out of their investments. The Fed has said they're going to keep rates at zero till about mid-2013. Okay, so you have at least another year of this agony in front of you. Now, sooner or later they'll rise. People, I can tell people, there's one investment I guarantee you will be a better investment in 5 years than it is now, and that's a money market fund. Sooner or later, rates are going to rise because they can't go any lower. They're at zero, okay? That's at 0.03%, okay? Now, we talked about expenses with bond mutual funds. And we said that when interest rates rise, bond prices fall, okay? So if you own a bond fund, its price will fall as interest rates rise because a bond fund has to be priced every day, okay? If you hold on to a bond, you're not going to take any big killing. And you say, okay, well, fine, the price will fall, but my dividend will rise, and that's true too. But realize that at 1.5%, if your bond fund is yielding 2%, you're giving away 3/4 of your interest payments, okay? So it's going to make the upturn in yields, downturn in prices even harder. So if you are hoping for higher yields in the future, it's probably better to buy, a 5-year bond every month and stagger it and wait for, yields to rise that way and roll it over each time, rather than a bond fund. Yeah. I've never liked international stocks, and it's not because I don't think everybody abroad is swell, but you have several risks that you don't have. One is currency risk. If the dollar rises in value, your holdings will fall in value. There's market risk. There's the risk that they'll be Italian or Spanish or something and fall. There's sovereign risk, which people who invested in Greek bonds found out that, they have a sovereign country, they can say, yeah, I'm not going to pay it. People in Argentina have done that about 6 times in the last 50 years. And there's also the risk, which is less true in developed countries, but more so in emerging companies, is that they don't have the same kind of disclosure that, that U.S. companies have. So, there's a lot of pre-mixed funds out there. If you say, life is short, I'd rather be golfing. I'd rather garden. And this is a perfectly sensible way to feel. There are pre-mixed funds. They're called target funds. There's 2 kinds. One will say, okay, are you willing to take a fair amount of risk, a little bit of risk, or no risk? And they'll gear their holdings towards that. And then you can go play golf and garden. There's other ones that say, okay, if you're going to retire in 2020, we'll gear our investments towards that. And as you get closer to your retirement age, we'll gear back on the risk. We'll put more money in cash, and we'll make things easier for you. They're not perfect, okay? It's not like someone's designing a perfect portfolio for you. But they're probably better than if you were just kind of muddling along by yourself, okay? So, if you have money to burn, and I hate myself for even suggesting it, but a lot of the big banks, many of whom were bailed out by all of us, are not going to go away. A bank is a very good way to make a lot of money. They often do. By and large, they pay good dividends. And right now, they're cheap because nobody trusts them, and rightfully so. However, as much as they say that they're going to let banks, they're not going to bail them out again, they would have to if they did the same thing. So if you can get J.P. Morgan or Citibank or Bank of America or Wells at current prices, there's no guarantees. Things happen. We could be on another recession, but they're cheap stocks. Junk bonds. I hesitate about this one too because you shouldn't reach for yields, but junk bonds are bonds issued by corporations with bad credit. If you believe the economy is going to improve, people with bad credit generally improve during these periods, which means their prices go up and you collect a yield of about 6 to 7% in the meantime. If things don't improve, they go bankrupt and you lose a lot of money. So there's your risk. Okay. And the other thing is real estate. There's real estate funds. You can buy funds that invest in commercial real estate. But housing is really cheap. Not only is housing really cheap, it's down 20 to 40% depending on where you live. Mortgage rates are stupidly low. My first mortgage was for 11%. I remember thinking I was really smart to get a rate that low, and that lasted for about a month. But you can get a mortgage if your credit's good for 3.5%, 4%. And although I will say I will now rather gnaw off my leg than be a landlord again. There's always some people who treat rent as something optional, like tipping. But if you have that temperament, or if you're thinking of buying a house, I think this is just a really swell time to do it. You can get a nice deal, affordable rates, and you can lock in a mortgage at lows we've never seen before. So I mean, I honestly think real estate is probably the best investment right now if you have patient. Yeah.
Refinancing a mortgage.
Pardon me?
Refinancing a mortgage.
I like refinancing as long as you don't fall into the trap of just extending your payments out longer. I mean, I think it's great if you can extend, if you have 20 years and you can go to a 15-year mortgage, pay about the same, you'll, or less. You shorten up the time you're paying a mortgage, you'll shorten the interest you pay over time. But if you have a 20-year mortgage and you refinance out another 30, then you're adding another decade of payments out there, and they may be low, but they're not that great. So I think that people always ask about paying off mortgages, and a paid-up mortgage is a wonderful thing to have in retirement. But the rate of return is roughly what you're paying in interest. Okay, so if you have a 5% mortgage, you're getting, all things being equal, about 5%, which is okay. It really depends on when you want to retire and whether you want to retire in that place. So we're in a very odd period in the financial world, and I've never seen anything like it in all my 26 years covering the financial markets. It's just extraordinary. So any other questions about? Farmland has done quite well, hasn't it? Yes, and
Per acre's gone up.
it's gone up. The only, I would say it's great if you're a farmer.
Oh.
If you're gonna, or if you know enough about it to know the deal. I mean, right now the corn crop is burning up, and so
Not a good year.
that may not, you know, it depends on how long that goes on, right? You know, if you don't get another good crop soon, then land prices will go down. Farmland has been an outstanding buy for many years, and it's not a secret anymore, I guess, is kind of what I would say. But if you know the local land and you see something come up, you know, all things being equal, yields per acre have increased dramatically in the last 20 years. So there's some justification for the increase in prices. There's two basic types of annuity. One is really more like a retirement savings. It's a tax-deferred investment. It's backed by an insurance company, and they will give you a return depending on any number of factors. Either a straight return on what they can afford. A variable annuity lets you guide it yourself, and so it's like a tax-deferred, it's like an IRA, 401k. The regular annuities, which are the old-fashioned kind where you give the insurance company money and then they give you payments for the rest of your life, are one of those things that make a degree of sense, although they make more sense when rates are higher. The problem with them is it's like Social Security. If you sign up for Social Security and you get your first check and you get run over by a bus on the way to cash it, that's it, okay? Unless you're married, there's some survivor benefits. An annuity is the same. A straight annuity is the same way, which is if you live 2 years and then keel over, the company gets your money. If you live to 115, they still have to pay you the same amount they promised to pay you. So it's a way of, I guess, hedging longevity is the way to look at it. SRI, as they call it, is interesting because, as I was telling somebody earlier, almost every company has done something awful at some point or another. There's always, you know, even Ben and Jerry's may have been mean to cows at some point. I don't know. But the idea is actually twofold. One is to avoid companies that actively do bad things. Okay, so companies that make landmines or things like that, you just say, okay, I don't want anything to do with that. Okay. There's another aspect, which is that you also kind of want to encourage companies that do good, that treat their employees well, that are good in the community, that contribute positively to society. So there's, generally speaking, what an SRI manager will do is they will first look at the universe of stocks and say, okay, which ones are likely to make money, okay? And then they put on top of that whatever social screens they may have. So, you know, we're not going to invest in guns. We're not going to invest in pornography. We're not going to invest in any other number of objectionable things. So they throw those out. And by and large, you can make just as good money being socially responsible as not being. The only time I can think of would you really would lag is when the oil companies are doing well, because it's really hard to, really hard to buy a oil company. You do have to be careful. There, you know, the Dreyfus funds once offered a fund called the Third Century Fund, I think it was, and it said, well, we think defense is a responsible thing, so we're going to invest in tanks. You know? So you really have to be careful as to what, you know, they have to spell out very carefully what they're going to invest in and what they're not going to invest in. So, yeah. Save more. I mean, that's kind of... Just start.
A savings account?
Yeah, a credit union is a good place. I like credit unions because their rates tend to be better. And, you know, for all, you know, people on Wall Street like to say, well, it's my financial wizardry that has brought you this far. But the single largest determinant of how much you're going to have is how much you save. It always comes down to that. So. They don't want you to know that, though, but it's true. I think there was a time back in the 90s when people thought, you know, I could put $500 into a fund and then I'll be set because it's growing at 19% a year or something like that. And it didn't pan out too well. So. Well, it depends on a couple of things. First of all, is you need to go through a reputable reverse lender, and there's fairly strict federal rules about how they can do it and how much they can give you and that kind of thing. You just have to realize that every payment you get is a slice out of your principal. You know, now if you're saying, look, I don't care what happens after I'm gone, you know, I'd like to live now and live decently, fine. You know, if it's going to augment your life, I have no problem with that. The problem you usually run into is with other family members who are saying, how could you do that? You know, and to which the answer is, get your own house. But yeah, I mean, I have reservations about it because there are people who are predatory in that area, and you know, I would go in with a good elder care lawyer and somebody like that who would look it over and make sure, you know, you're getting everything correct. But yeah, if you find that's something and you don't have a problem with, you know, the effects on your estate, why not? You know, life's for the living, as my mother used to say. So.